Hello guys, and welcome to this new video. Today we will be talking about 3 of the most powerful chart patterns in trading, which you can easily use and incorporate into your own trading strategy. Now before we begin, in order to encourage us to produce more educational material for free, please don't hesitate to hit the subscribe button and also turn on the notification bell. Now here's exactly what we will be covering in this video. We will first begin with the head and shoulders pattern, then the double tops and bottoms, and finally we will finish with the trend line pattern. Let's begin with the head and shoulders pattern. In the following chart we see 3 peaks. The center peak here, which is the highest, and it's called the head, and the 2 others which form the shoulders. Now after these 3 peaks are identified, it's time to draw the neckline, which is basically a line that connects all the lowest points from each side of the head. Now when this pattern is well identified, the idea to trade this pattern is when the market breaks below the neckline, we have a chance to see a major retracement, or even more, a change of trend direction. So to trade this opportunity, we will focus on 2 methods. In this first example, this candle is breaking the neckline, but the problem is there is no much volume. So the market might be ranging for some time, and what we have to do is that we need to wait for a little break of the market with low volatility forming like a triangle. Now in this second candle, with clearly higher momentum, we will put our entry right after the candle closes, putting our stop loss right here in this area, and we simply target the next demand zone. See what happens next. The market goes down and hits our take profit. In the second example, what we see here is a reverse head and shoulders. Again, we draw our neckline, and we can immediately spot a clear breakout with a high momentum and a big volume. Even though the neckline is clearly broken, we will wait for a little retracement. And in this case, the market retested this demand zone, which offers a perfect entry, with a stop loss right below and a take profit in the next zone of supply. And as expected, we hit our target. In the next section, we will discuss a few mistakes that traders usually make when trading the head and shoulders pattern. The first thing you need to know is that the market won't change its direction simply because we have a head and shoulders pattern. There are other factors we should consider. For instance, the strength and duration of the trend. For example, here we have a clear head and shoulders, but the market continues and the pattern fails. Now, in order to understand why this is the case, we need to take a deeper look at the market. We can easily see that the market is forming higher highs and higher lows, building a very strong uptrend. This uptrend takes a long time to form, but the head and shoulders pattern is forming very quickly, which means that the market is likely to retrace for a little bit and then continues its direction rather than reversing to a downtrend. The key point to remember here is don't short or long the market just because you see a head and shoulders pattern. Always look for both the strength and duration of the trend. Another common mistake among traders is assuming a big stop loss. For example, here the market broke the neckline, and most traders would jump right into this trade, putting their entry here and the stop loss above the head point. In this case, stop loss will be huge, and in terms of risk to reward, they will have to deal with a very poor ratio, most likely 1-to-1 or even less. So make sure your entry is in the right place and your stop loss too. Always try to minimize the stop loss as much as possible for a good risk to reward ratio. Let's move on now to the double tops and bottoms pattern. Double tops and bottoms are one of the most well-known and powerful money-making techniques used by Forex traders. A double top occurs when the price attempts to break out above a recent pivot high but fails. This pattern consists of 2 tops of approximately equal height. An important rule that you should remember is that double tops are not as strong in an uptrend as they are in a downtrend, which means that we shouldn't trade against a strong uptrend. On the opposite side, we have the double bottom pattern, forming two lows with same level. Again, same rule applies. Double bottoms are not as strong in a downtrend as they are in an uptrend, so we shouldn't trade against a strong downtrend. In order to validate the double tops and bottoms pattern, we should follow simply these two basic rules. The first one is we always need to see a little price action between the two tops and the two bottoms, most likely forming like a V shape between them. The second one, we need to have a minimum pullback to the last pivot point, which means that the price must retest the previous high in a double tops or the previous low in a double bottoms. Now let's see what are the trading opportunities that involves a double tops or bottoms pattern. In the first example, we see that the double tops pattern is perfectly validated, which means that there is a chance to short the market. We see that after the price retested the last high, we put our entry after the close of the next candle, and we put our stop loss above the last high with a small stop, and we target the next demand zone. There is another way to enter this trade by setting a sell limit in this area with same stop loss. Of course, this entry is a little bit risky, but it also offers a good risk to reward ratio. In the opposite side, we see a clear double bottoms pattern. Nice price action between the two lows with the price retesting the previous one. We also see here a neckline above the high between the two lows. The idea of this trade is that we will enter after the neckline is broken and retested. In order to enter this trade, we can also use the Fibonacci tool, and our entry will be in the area between 0.5 and 0.618. And as usual, we target the next supply zone, making our stop loss right here under this low. Finally, we arrive at our last chart pattern, which is a trend line. It's clear now that the market goes either in an uptrend, making higher highs and higher lows, in a downtrend, making lower lows and lower highs, or simply in a range, making highs and lows of approximately the same level. Here the market is going up, forming higher highs and higher lows, which indicates that we are dealing with an uptrend. We can clearly draw the trend line from the lows connecting these key price areas, also known as support. In this second chart, the market is forming lower highs and lower lows, so in this case we are in a downtrend. Now we draw our trend line from the highs connecting these key price areas called resistance. Now an important thing to keep in mind is that the trend line is only a reference to what an ideal trend in price movement looks like, but the price can easily deviate. How do we evaluate the strength of a trend line? As we've seen before, the trend line always forms key levels which the market takes as support and resistance. The power of a trend line is usually valued after the third retracement. That's when good trading opportunities arises. The trend line is strong when we see a clear reaction after the third retracement, which means that the market always reacts with good volume in a strong trend. Another element to consider when evaluating a trend line is that the longer the market takes to form a trend, the stronger the trend line would be. For example, here we see an uptrend. The problem is there isn't suitable price movement to apply a good trend line. You could of course apply a super tight one like this, but that does not help your overall analysis. So in this case, we simply don't take it into consideration. In the following section, we will be given two methods to trade the trend line strategy. Now the first one is simply trading with the trend. In this example here, we see a clear uptrend making higher highs and higher lows. So connecting these key points, we find our trend line. We also see the first and second time the price touched the trend line, which means that we will validate our pattern after the third one. Now in order to take this trade, we will wait for a clear price action after the third retracement. After that, we will make our long order and set our stop loss right below the trend line, targeting the next supply area. This entry can be considered aggressive, but to be more confident in our trade, we can look at this cluster area where a lot of traders have their eye on. meaning that there is a higher probability that traders will be taking action. In our case, we have a nice support zone where the price reacted many times. Combined with the third touch of the trend line, we have a high probability that the price can go up from here. You can also use different tools combined with the trend line in order to time your entry. For example, Fibonacci, supply and demand, and also moving averages. The second method we'll be discussing is the trend line breakout. Now in this example here, we see a downtrend which is confirmed by the lower highs and the lower lows. As usual, we draw our trend line connecting the key level points. We can immediately see that the price broke the trend line after the third touch. That's why in this case, we will be using the breakout strategy. Now after the breakout, we usually wait for a retest of the trend line for a good entry. But in this case, if the market goes up without a retest of the trend line, you can also take advantage of this opportunity by waiting for the break of structure here. After the price broke this high, we can validate the trend reversal and take our trade, making our stop loss below this area and targeting the next supply zone, or even more, the head of the trend. I hope you enjoyed this video. Thank you for watching and see you in the next one.